My name's Scott Slaby. I'm from Denver, Colorado. First off, I'd like to thank Mr. Buffett and Mr. Munger for having us out here today. I appreciate you bringing us out here, so thank you very much.
And thank you.
It's great that you answer our questions. I'm a former teacher, or I'm a teacher. I shouldn't say former. Being a former teacher yourself, I see a problem with financial literacy with our future generations, and I'm curious what you think future generations should know, and if there's anything that needs to be in school curriculums to teach younger people financial literacy as we move forward.
Yeah, I think there's a problem with financial literacy with our current generation, but there's Andy Hayward, who has helped us with the cartoon, he sold his company last year, but he has a new company, and he will have a program coming out that works on that question, and that I play a very small part in. ABC has a program coming up with a number of well-known personalities in it that will deal with the question of financial literacy, and it is a tough sell in a world of credit cards and world that depends on calculators rather than people sitting down and doing actual arithmetic and all of that to teach people. But in the end, I think we make progress over time. I mean, I hope our annual reports contribute to that sort of thing. But you're going to have people doing very foolish things with money. I remember on my honeymoon, I was 21 and my wife was 19, and we drove west. I'd never been to Las Vegas, and it was 1952, and we stopped at the Flamingo, and people were better dressed in the casinos then, and there were a bunch of Omaha fellows that actually owned part of the Flamingo at that time. Terribly nice to us, but I looked around at that casino and I saw all kinds of well-dressed people who had traveled thousands of miles to do something very dumb. And I thought, this is a country where you're going to get very rich. If people are going to get on a plane in New York and fly a couple thousand miles to stand there and do things with a mathematical expectation that's negative on every action they take, it's a world of opportunity. So I recommend that you work with your students. I started teaching at the University of Omaha, when I was 21, and you work with your students to make them literate, and they will have a terrific advantage. Charlie?
Well, a world where legalized gambling is now conducted by a great many states in the form of lotteries, where people are encouraged to bet against the odds, and a world where we have a vast overuse of high-cost credit card debt. It needs a lot more financial literacy. I would argue literacy. I think we've been going in the wrong direction. So I don't think you can teach people high finance who can't use a credit card intelligently.
Yeah, if you're, I talk to students about that. If you're willing to pay 18 or 21% on a credit card, and the credit card companies need it, incidentally, currently, because you have losses running close to 10%. So with expenses, they may need that, but there's no way that you're going to financially come out borrowing money at those kind of rates, and I wouldn't know how to do it, and it's too bad. On the other hand, it's probably good for our business. I mean, we are looking for things that are mispriced, and the more people think that borrowing money on credit cards is intelligent, they probably will not think that doing long-term equity put contracts is intelligent. And we'll go our way and they'll go their way. Becky?
This question comes from James Lewis from Logan, Ohio, who said it was okay to use his name and city. He says, one of the substantial investments of Berkshire is Wells Fargo. The chairman of Wells Fargo supposedly indicated that he did not want to take TARP funds from the federal government. He furthermore recently said that some of the programs of the federal government to reinvigorate the banks were asinine. Mr. Munger, do you agree with the chairman of Wells Fargo? And please explain why you do or do not agree. And Mr. Buffett, do you agree with Mr. Munger?
Yes.
When a government is reacting to the biggest financial crisis in 70 years, which threatens important values in the whole world, and the decisions are being made hurriedly and under pressure and with good faith, I think it's unreasonable to expect perfect agreement with all of one's own ideas. I think the government is entitled to be judged more leniently when it's doing the best it can under trouble. Of course, there's going to be some reactions that are foolish, and I happen to share one of the troubles of some of the Wells Fargo executives in that I'm pretty blunt. I happen to think that the accounting principle that says your earnings go up as your credit is destroyed, because if you had any money left, you could buy your own debt back at a discount. I happen to think that's insane accounting, and I think the people who voted it into effect ought to be removed from the board. So a man who talks like that has to have some sympathy with the people at Wells Fargo.
He usually gets to hang him by their thumbs, but he held back this morning. The government in September, mid-September last year, really did. They were facing a situation that was as close to a total meltdown throughout the financial system as I think you can imagine. You had a couple $100 billion move out of money market funds in a couple of days. You had the commercial paper market freeze up, which meant that companies all over the country that had nothing to do with the financial world basically were going to have trouble meeting payrolls. We really were looking into the abyss at that time, and a lot of action was taken very promptly. And overall, I commend the actions that were taken. So as Charlie says, to expect perfection out of people that are working 20-hour days and are getting hit from all sides by new information, bad information. That one weekend with Lehman going, AIG going, Merrill would have gone, in my view, unless the B of A had bought it. I mean, it was when you're getting punched from all sides and you have to make policy and you have to think about congressional reaction and the American people's reaction, you know, you're not going to do everything perfectly. But I think overall they did a very, very good job. I'm sympathetic. That remark was made by Dick Kovacevich, who came in second last year to Charlie in the plain speaking contest around the world. And it's true that Dick Kovacevich was called on a Sunday at little after noon, as I understand it, and told to be in Washington the next day at 1 or 2 o'clock without being told what it was about. And there were 11 bankers there and some officials, and they were told that they were going to take TARP money and they were going to take loans from the government and preferred stock, and that they only had an hour or two to sign it, and they didn't get to consult with boards. But that's the nature of an emergency, you know. I think you're going to have some decisions that later can be looked back at, and somebody will say I could have done it a little bit better. But by and large, the authorities, in my view, did a very good job. And all banks aren't alike by a long shot. And in our opinion, Wells Fargo is among the large banks, particularly. It's a fabulous bank and has some advantages that the other banks don't have. But at a time like that, you're not dealing in nuances. Incidentally, I would recommend to all of you that you go to the internet and read Jamie Dimon's letter to his shareholders, Jamie Dimon of J.P. Morgan Chase. It's a fabulous letter. It talks about a point that Charlie made there, but Jamie did a great job of writing about what caused this and and what might be done in the future. It's as good a shareholder's letter as I've ever seen. So by all means, look it up. It's long, but it's worth reading. Okay, we'll go to area 2.
My question is free cash flow. Sell-side analysts like to do a 10-year discounted cash flow analysis with the terminal value. Even some of the books written about your style, the Warren Buffett way, Buffettology, imply that you go through that exercise. But I know you're famous for not using computers or calculators. I'm wondering if those type of exercises fall into the too hard file, and you just do a simple free cash flow, normalized free cash flow over a discount rate. And if you care to augment the answer with your numerical analysis of Coke, I'd appreciate that.
Well, the answer is that all investing is laying out cash now to get more cash back at a later date. Now, the question is, how much do you get back? How sure are you of getting it? When do you get it? It goes back to Aesop's fables, you know. A bird in the hand is worth two in the bush. Now, that was said by Aesop in 600 BC now. And he was a very smart man. He didn't know it was 600 BC, but, I mean, he couldn't know everything. But that's what's being taught in the finance. You get a PhD now, and you do it more complicated, and you don't say a bird in the hand is worth two in the bush, because you can't really impress the laity with that sort of thing. But the real question is, how many birds are in the bush? You know you're laying out a bird today, the dollar. And then how many birds are in the bush? How sure are you in the bush? How many birds are in other bushes? What's the discount rate? In other words, if interest rates are 20%, you got to get those two birds faster than if interest rates are 5%, and so on. That's what we do. I mean, we are looking at putting out cash now to get back more cash later on. You mentioned that I don't use a computer or calculator. If you need to use a computer or calculator to make the calculation, you shouldn't buy it. I mean, it should be so obvious that you don't have to carry it out to tenths of a percent or hundredths of a percent. It should scream at you. So if you really need a calculator to figure out that the discount rate is 9.6% instead of 9.8%, forget about the whole exercise. Just go on to something that shouts at you. And essentially, we look at every business that way. But you're right. We do not sit down with spreadsheets and do all that sort of thing. We just see something that obviously is better than anything else around that we understand, and then we act. And Charlie, you want to add to that?
Well, I'd go further. I'd say some of the worst business decisions I've ever seen are those that have done with a lot of formal projections and discounts back. Shell Oil Company did that when they bought the Belridge Oil Company, and they had all these engineers make all these elaborate figures. And the trouble with that is you get to believe the figures, and it seems that the higher mathematics with more false precision should help you, but it doesn't. The effects averaged out are negative when you try and formalize it to the degree you're talking about it. They do that in business schools because, well, they've got to do something.
There's a lot of truth to that. I mean, if you stand up in front of a class and you say a bird in the hand is worth two in the bush, you know, you're not going to get tenure. So it's very important, if you're in the priesthood, to look at least like you know a whole lot more than the people you're preaching to. And if you come down and just, if you're a priest and you just hand down the 10 Commandments and you say this is it, and we'll all go home, you know, it just isn't the way to progress in the world. So the false precision that goes into saying this is a 2 standard deviation event or this is a 3 standard deviation event and therefore we can afford to take this much risk and all that, it's totally crazy. I mean, you saw it with long-term capital management in 1998. You've seen it time and time and time again. And it only happens to people with high IQs. You know, those of you who have 120 IQs are all safe. But if you have a very high IQ and you've learned all this stuff, you know, you feel you have to use it. And the markets are not that way. The markets of mid-September last year, when people who ran huge institutions were wondering how they were going to get funding the next week, that doesn't appear on you can't calculate the standard deviation that arises at. It's going to arise much more often than people think in markets that are made by people that get scared and get greedy. And they don't observe the laws of flipping coins in terms of the distribution of results. And it's a terrible mistake to think that mathematics will take you a long place in investing. You have to understand certain aspects of mathematics, but you don't have to understand higher mathematics. And higher mathematics may actually be dangerous, and it will lead you down pathways.
I'm Lori Gould from Berkeley, California. Where do you see the residential real estate market headed nationally, particularly in California, over the next year or two?
Well, we don't know what real estate is going to do. We didn't know what it was going to do a few years ago. We thought it was getting kind of dangerous in certain ways, but it's very hard to tell. I would say this, from what I'm seeing, and I do see a lot of data. And California, incidentally, is a very big. I mean, there are many markets within California. Stockton is going to be different than San Francisco and so on. But in the last few months, you've seen a real pickup in activity, although at much lower prices. But I think you've seen something in the medium to lower price houses, and medium means a different thing in California than it does in Nebraska. But you've seen in maybe $750,000 and under houses, you've seen a real pickup in activity, many more bidders. You haven't seen a bounce back in price. Prices are down significantly, and it varies by the area. But it looks as if you had a foreclosure moratorium for a while, and so you get into distortions because of that. But what it looks like, looking at our real estate brokerage data, and we have the largest real estate brokerage firm in Southern California, in Orange County, Los Angeles County, and San Diego County, and Prudential of California, that's owned by Mid-America. We see something close, I would say, to stability at these much reduced prices in the medium to lower group. If you got a $5 million house or $3 million house, that still looks like a very erratic. It's a market in which there still isn't a lot of activity. But in the lower levels, there's plenty of activity now. Houses are moving. Interest rates, of course, are down, so it's much easier to make the payments. The mortgages being put on the books every day in California are much better than the mix that you had a few years earlier. So it's improving, and I don't know what it'll do next month or 3 months from now. The housing situation is pretty much this way. You can look at it this way. We create about 1,300,000 or so households a year. It bounces around some, and it tends to, in a recession, it tends to be fewer because people postpone matrimony and so on to some extent. But if there's 1,300,000 households created in a year, and you create 2 million housing starts annually, you are going to run into trouble. And that's what we did. We just created more houses than the fundamental demand was going to absorb. So we created an excess of houses. How much excess is there now? Perhaps 1.5 million units. We were building 2 million units a year. That's down to 500,000 units a year. Now, if you create 500,000 units a year and you have 1,300,000 households created, you are going to absorb the excess supply. It will be very uneven around the country. South Florida is going to be tough for a long, long time. So it isn't like you can move a house from one place to another if there's demand in one place and not another. But we are eating up an excess inventory now, and we're probably eating it up at the rate of 700,000 or 800,000 units a year. And if we have 1.5 million excess, that takes a couple of years. There's no getting away from it. You have three choices. You could blow up 1.5 million houses, and if they do that, I hope they blow up yours and not mine. But that's it. we could get rid of it. We could try to create more households. We could have 14-year-olds start getting married and having kids, or we can produce less than the natural demand increase. And that's what we're doing now. And we're going to eat up the inventory. And you can't do it in a day and you can't do it in a week. But it will get done. And when it gets done, then you will have a stabilization in prices. And then you will create the demand for more housing starts. I mean, then you can go back up to 1.25 million. And then our insulation business and our carpet business and our brick business will all get better. Exactly when that happens, nobody knows. But it will happen. Charlie?
Well, I think in a place like Omaha, which never had a really crazy boom in terms of housing prices, with interest rates so low if you've got good credit, that if I were a young person wanting a house in Omaha, I would buy it tomorrow.
We own the largest real estate brokerage firm in Omaha, so Charlie will be called. If he qualifies, we will give him a mortgage application. It is true that 4.5 million houses will change hands this year. There's about 80 million houses in the country. 25 million of those do not have a mortgage. About a third of the houses in the country do not have a mortgage. You got about 55 million or a little less that have a mortgage. And 5 or 6 million of those are in trouble one way or another. But we're selling 4.5 million houses every day. And by and large, they're going into stronger hands. The mortgages are more affordable. The down payments are higher. The situation is getting corrected. But it wasn't created in a day or a week or a month. It's not going to get solved in a day or a week or a month. We are on the road to solution.
Hi, Warren. That's a little loud. Sorry. Hi. My name's Sarah, and I'm from Omaha, Nebraska. I'd like to know if you could explain your strategies, namely value investing, in regards to cultivating the next generation of investors. How will you teach this young group?
Well, I had 49, mostly universities, a few colleges, that came to Omaha this year. We do them in clumps of 6, and then the last one we had an added university. So we had 8 sessions, full-day sessions. And they asked me sometimes they asked me what I'd do if I was running a business school teaching investments. And I tell them I'd only have 2 courses. One would be how to value a business, and the second would be how to think about markets. And there wouldn't be anything about modern portfolio theory or beta or efficient markets or anything like that. We'd get rid of that in the first 10 minutes. But if you know how to value a business, and you don't have to know how to value all businesses. On the New York Stock Exchange, I don't know, there's 4,000 or 5,000 probably businesses and a whole lot more on NASDAQ. You don't have to be right on 4,000 or 5,000. You don't have to be right on 400. You don't have to be right on 40. You just have to stay within the circle of competence, the things you can understand, and look for things that are selling for less than they're worth of the ones you can value. And you can start out with a fairly small circle of competence and learn more about businesses as you go along, but you'll learn that there are a whole bunch of them that simply don't lend themselves to valuations, and you forget about those. And I think if accounting helps you in that, you need to understand accounting to know the language of business, but accounting also has enormous limitations, and you have to learn enough to know what accounting is meaningful and when you have to ignore certain aspects of accounting. You have to understand when competitive advantages are durable and when they're fleeting. I mean, you have to learn the difference between a hula hoop company, and Coca-Cola. But that isn't too hard to do. And then you have to know how to think about market fluctuations and really learn that the market is there to serve you rather than to instruct you. And to a great extent, that is not a matter of IQ. If you're in the investment business and you have an IQ of 150, sell 30 points to somebody else because you don't need it. I mean, you need to be reasonably intelligent, but you do not need to be a genius at all. In fact, it can hurt. But you do have to have an emotional stability. you have to have sort of an inner peace about your decisions, because it is a game where you get subjected to minute-by-minute stimuli where people are offering opinions all the time. You have to be able to think for yourself. And I don't know how much of that's innate and how much can be taught. But if you have that quality, you'll do very well in investing if you spend some time at it, learn something about valuing businesses. It's not a complicated game. As I said many times, it's simple but not easy. It is not a complicated game. You don't have to understand higher math. You don't have to understand law. There's all kinds of things that you don't have to be good at. There's all kinds of jobs in this world that are much tougher. But you do have to have sort of an emotional stability that will take you through almost anything, and then you'll make good investment decisions over time. Charlie?
Yeah, you do have the basic problem that exactly half of the future investors of the world are going to be in the bottom 50%. In other words, you're always going to have more skill at the top than you have at the bottom, and you're never going to be able to homogenize the investment expertise of the world. There is so much that's false and nutty in modern investment practice and in modern investment banking and in modern academia, in the business schools, even the economics departments, that if you just reduce the nonsense, that's all I think you should reasonably hope for.
Beyond a certain basic level of skill, wouldn't you say your emotional makeup's more important than some super high degree of skill?
Absolutely. And if you think your talent, if you think your IQ is 160 and it's 150, you're a disaster. Much better a guy with 130 that's operating well within himself.
I get to see the students that come by. I love the fellow from the University of Chicago. One of the students, and the first question that was asked to me is, what are we learning that's most wrong? I mean, that's the kind of, I wish they'd ask that sort of thing of the panel here.
How do you handle that in one session?
Yeah. But it was Holy Writ 25 years ago, efficient market theory, that I never understood how you could even teach it. I mean, if you walked in the first 5 minutes, you said to the students, everything is priced properly. I mean, how do you kill the rest of the hour? But they did it, and they got PhDs for doing it well. And the more Greek symbols they could work into their their writings, the more they were revered. It's astounding to me, and it may have even given me a jaundiced view of academia generally, is the degree to which ideas that are nutty take hold and get propagated. And then I read a quote the other day that may have partially explained it. Max Planck was talking, the famous physicist, Max Planck was talking about the resistance of the human mind, even the bright human mind, to new ideas, and particularly to ones that had been developed carefully over many years and were blessed by others of stature and so on. And he said, science advances one funeral at a time. And I think there's a lot of truth to that, and it's certainly been true in the world of finance. Okay, Andrew.
We have a succession question. However, this one has a twist coming from Ben Knoll. You famously said, quote, you should invest in businesses that a fool can run because someday a fool will. Given your reinsurance company's capacity and inclination for big financial bets, can you provide us more reassurance about the risk once Ajit is gone? Do you have a succession plan for him? Ben says, the Titanic-like ending at AIG, once Greenberg was gone, has me spooked.
Yeah, I would say that it would be impossible to replace Ajit, and we wouldn't try, and therefore we wouldn't we wouldn't give the latitude in terms of size of risk or that sort of thing that we give to Ajit. No, we've got a unique talent in my view there, and I think in Charlie's. And so when you get somebody like that, you give enormous authority to them after you firmly establish in your mind that that's who you're dealing with. But that doesn't mean that the authority goes with the position. The authority goes with the individual. And we would not, giving your pen away in insurance, as they say, is extraordinarily dangerous. And we have in this town, we have Mutual of Omaha, which in the 1980s had been built up carefully over probably 75 years by that time and become the largest health and accident association in the world, I believe. And they got the idea that they should be writing property casualty reinsurance. So they gave a pen to somebody within the place, and probably nobody even heard the guy's name, and in just signing a few contracts, they lost half their net worth in a very short period of time, and they were worried that they might have lost more than that. So you can do enormous damage in the insurance business with a pen, and you better have to be very careful about who you give your pen to. And we've given our pen to Ajit in a way that we wouldn't give it to anybody else. Now, it just so happens that I enjoy hearing about the kind of things he does, so we talk daily, but we don't talk daily because he needs my approval on anything. We talk daily because I find it very interesting when he says, how much should we charge to insure Mike Tyson's life for a couple of years? I mean, that's the kind of thing I can get kind of interested in. I asked him whether there was an exclusion in case he got shot by a woman that felt unhappy about her treatment or something, but and it makes a difference in the price. But I enjoy that sort of thing, but I'm not needed, and Ajit is needed, and we won't find a substitute for him. And there's some things that just have to be faced that way. Charlie?
Yeah, what that quotation indicates is sometimes stated differently. You say, if it won't stand a little mismanagement, it's not much of a business. Of course you prefer a business that will prosper pretty well, even if it's not managed very well. But that doesn't mean you don't like even better when you get such a business that's managed magnificently. And both factors are quite important. We're not looking for mismanagement. We like the capacity to stand it if we stumble into it, but we're not looking for it.
Yeah, we will not do things that we think are, we will not assign tasks to people that we think are beyond their capabilities. And it just so happens that Ajit has enormous capabilities, so he gets assigned some very unusual things. But you don't see that prevailing throughout our insurance operation, and our managers don't expect to operate that way. That's a one-off situation with Ajit, and he's in good health, and we send him all the cherry coke or fudge that he wants. Okay, area 6.
Hi, Mr. Buffett. Hi, Mr. Munger. My name is Mary Kimball from New York City. In getting back to basics, what do you think Ben Graham would have said about derivatives?
He would not have liked them. I think he probably would have said pretty much what I said back in 2002, that they pose a real risk to the system. They cause leverage to run wild. They cause counterparties to sign up for things that may be difficult to achieve under certain circumstances, that they place an already fragile economic system, added strains on them which can pop up in unpredictable ways. But he would probably also say if he saw something that were mispriced, he would act accordingly. But he wouldn't get himself in a position where the problems of the people who didn't act prudently could cause him any problems. And I think that probably would be the answer. One basic problem about derivatives, there's several problems. I mean, after 1929, Congress met there was a Pecora committee and so on, and they decided that it was very dangerous to let people borrow a lot of money against securities, and that it contributed to the Great Depression. And therefore, they said the Federal Reserve should regulate how much people could borrow against securities, and it was important for society. And the Federal Reserve started requiring margin, they had margin requirements. Those requirements still exist. You are not supposed to be able to borrow more than 50% against your securities. Actually, during one period, they went to where they didn't, the Federal Reserve allowed no borrowing whatsoever. They went to 100% margin. But derivatives came along and just turned that into made those rules a laughing stock. You have what they call total return swaps, which means you can borrow 100% against what you own. That goes way beyond anything that existed in 1929. So derivatives became a way around regulation of leverage in markets, which, like I say, Congress felt was important, and the Federal Reserve still has the responsibility for enforcing. Derivatives also meant that settlement dates got pushed out. One of the problems in securities markets comes about when you have a trade today. If you didn't have to settle it for a year, you'd find it very hard sometimes to find a person on the other side. And derivatives allow these very long settlement periods, whereas security markets demand them in 3 days. There's a reason they demand them in 3 days. As you extend out periods, you get more and more defaults. So they're a danger. They are a danger to the system. There's no question about that. We have a book in the bookworm called The Great Crash by Galbraith. It's one of the great books. You really ought to buy it. It tells the story of the 29, and it gets into margin requirements. So Ben Graham would not like a system that used derivatives heavily, but I don't think he would have been above, if he saw something that looked way out of line and he knew he could handle it himself, I think he would have been quite willing to buy or sell one that was mispriced. Charlie?
I think there's been a deeper problem in the derivative business. The derivative dealer takes two advantages of the customer. One, there's a croupier-style mathematical advantage equivalent to the house advantage in Las Vegas. And two, the derivative dealer is playing in the same game with his own clients with the advantage of being a better player.
And having knowledge of what they're doing.
And having knowledge of what the clients are doing. This is basically a dirty business. And you're really selling things to your clients who trust you that are bad for the clients. We don't need more of this kind of thing in America. We need less.
My name's Kelly Cardwell from Warrenville, Illinois. Guys, if either of you were starting a smaller investment fund today, let's say in Warrenville, Illinois, $26 million fund called Central Square Capital, hypothetically.
Well, you'll get billed for a commercial later on.
With the smaller asset base, what would you do differently, both in terms of the number of positions and frequency of turnover? For example, if you owned a portfolio of 10 stocks and 5 of them doubled in a short time period, would it make sense to actively manage the portfolio and take profits in the 5 that had doubled and redeploy the proceeds into your positions into the ones that had not moved higher, where presumably more upside exists and the odds are more dramatically stacked in your favor? Or would you favor the strategy of sitting on your hands in the name of long-term investing?
We would own the half a dozen or so stocks we like best, and we wouldn't have anything to do with what our cost on them was. It would only have to do with our evaluation of their price versus value, and it doesn't make any difference what the cost is. And incidentally, if they went down 50%, we would say the same thing. And using your illustration, I don't know whether that fund has actually had something that went up or went down. So we would our cost basis, except in rare cases, and we actually have a situation like this at Berkshire now, which I may explain a little later, but the cost basis doesn't have anything to do with the fund. When Charlie and I ran funds, we didn't worry about whether something was up or down. We worried about what it was worth compared to what it was selling for, and we tried to have most of our money in relatively very few positions which we thought we knew very well. We do the same thing now. We do the same thing 100 years from now. Charlie?
Yes, he's tactfully suggesting that you adopt a different way of thinking.
No.
This question is from Michael Welter of Portland, Oregon. You've often said that two things you look for in an investment are a sustainable competitive advantage and a simple, easy-to-grasp business model. Berkshire's sustainable competitive advantage is arguably you, Warren and Charlie, and that obviously is not sustainable over the long term.
I reject that defeatism.
I knew you would. While at this point, Berkshire does not have a simple, easy-to-grasp business model. So if the two of you were outside investors, is it possible that no matter what combination of intrinsic value and price Berkshire offered, you would not invest in it today?
No, our sustainable competitive advantage is we have a culture and a business model which people are going to find very, very difficult to copy, even semi-copy. We have an unusual group of shareholders. We have a business that's owned by people where the turnover on our stock, even allowing for all the double counting and everything like that, maybe something like 20% a year, when virtually every stock in the S&P 500 turns over 100% a year. So we have a different shareholder base. We have people that understand their business differently, and we have a business that can offer to people who own private businesses the chance to keep running their businesses as they have in the past and get rid of the problems of lawyers and bankers and all kinds of things like that. And I don't see any other company in the United States that has the ability to do that now, or probably the ability to adopt that model in any big way. So I would say we have sort of an ultimate, and it's not peculiar to me and Charlie. We may have helped create it, but it is a deeply embedded culture which any CEOs that follow are going to be well versed in when they come into the job, dedicated to, and able to continue in the future. And you can't do, I don't want to name names about other companies, but you can't do that elsewhere. So I think anybody wanting to copy Berkshire is going to have a very hard time. And I think the advantages we have are going to be very, very long lasting, and they're not peculiar to the fact that Charlie and I are sitting up here anymore. They may have been originally, but no longer. Our culture, our managers join that culture. Our shareholders join that culture. It gets reinforced all the time. They see that it works. You know, it's something that I don't know how I would copy it if I were running, some other company. And it's meaningful because there will be businesses, just as there was with ISCAR a while back, just as the management at GEICO felt back in the mid-90s in terms of what they wanted to do. There will be people that want to join up with us, and they really won't have a good second choice. There'll be plenty that don't, too, but that's okay. We just need to have the right ones, some of the right ones join us, and it can go on a long, long time. Charlie?
Yes, I might state that a little differently. A lot of corporations in America are run stupidly from headquarters as they try and force the divisions to come up with profits for every quarter that are better than the profits in the same quarter in the previous year. And a lot of terrible decisions and terrible practices creep into those businesses. In the Berkshire model, that doesn't happen. So while Warren and Charlie will soon be gone, not too soon in my case, but I'm a little worried about Warren.
Hello, Mr. Buffett, Mr. Munger. My name is Aznur Midov. I'm from Famous Tudor Organization, San Francisco. And my question is from one of financial blogs. How do you justify holding stocks forever when the fundamentals have permanently changed?
Well, the answer is we don't. if we lose confidence in the management, if we lose confidence in the durability of the competitive advantage, if we recognize we made a mistake when we went into it, we sell plenty of time. So it's not unheard of. On the other hand, if you really get a wonderful business with outstanding management, but mostly the wonderful business part of it, when in doubt, keep holding. But it's no inviolable rule. Now, among the businesses we own, not just securities we own, we have an attitude which we express in our economic principles that when we buy a business, it's for keeps. And we make only two exceptions: when they promise to start losing money indefinitely, or if we have major labor problems. But otherwise, we are not going to sell something just because we get offered more money for it, even than it's worth. And that's a peculiarity we have, and we want our partners to know about that. We do think it probably helps us in terms of buying businesses over time. It's also the way we want to run our business. But with stocks, bonds, we sell them, but we're more reluctant to sell them than most people. I mean, if we made the right decision going on, we like to ride that a very long time, and we've owned some stocks for decades. But if the competitive advantage disappears, if we really lose faith in the management, if we were wrong in the original analysis and that happens, we sell. Or if we find something more attractive, normally we have plenty of money around. But in September of last year, late September, we had committed to put $6.6 billion in Wrigley. And then Goldman Sachs needed $5 billion, GE needed $3 billion. I sold a couple $1 billion worth of J&J just because I didn't like getting our cash level down below a certain point under the circumstances that existed then. That was not a negative decision on J&J. It meant that I wanted a couple billion more around, and I saw an opportunity to do something that I probably wouldn't see too much later, whereas I could always buy J&J back at a later date. But that's an unusual situation.
This is a question from Human Tamadden in Seattle, Washington. He's got a two-part question, but he says, from time to time, you purchase shares of public companies. Presumably, you feel that those shares are a better investment than Berkshire shares at the time, since you never buy back Berkshire shares. If Berkshire shareholders can purchase shares in the same companies for the same price as you, why shouldn't they sell their Berkshire shares and buy what you are buying? And secondly, he wants to know why, because he, like thousands of other shareholders, is unable to attend the annual meeting. How come Berkshire does not webcast the meeting? I am aware of the irony that I will not hear your answer.
Yeah. Well, our meeting does get written up, at least it gets written up a lot with various blogs and everything else. It gets written up pretty well in its entirety by Outstanding Investor Digest. And there are others that prepare extensive reports on it, and they pop up on the internet. So he will, in all likelihood, find out the answer. We could webcast. I get asked the same question about webcasting the meetings I have with students. Why not do that? It's so much easier and everything. I think there is something gained by personal contact. I certainly know that when I was studying and all of that, I gained a lot by personal contact, even though I'd read Ben Graham's books, just going and being with him. And I follow that practice in teaching, and I think that I like the turnout we get. I like our partners to show up and see the products we sell and all of that. This is not something where we're going to go and hide and hold our meeting, in some hamlet, in western Nebraska or something to discourage attendance. We've got a different attitude, and I think that I hope that comes across. And I think that if we webcast it, it was something like turning on a television show, I don't think it would be quite the same. In terms of the first part of the question about buying the securities we buy, plenty of people do that, and some of them. But they incidentally, they're not buying it with free float that's available from insurance. So if they have $58 billion that they can get interest-free, they will be in the same position we are in buying those securities. But they are, on the other hand, they have some tax advantages we don't have. So I don't quarrel with people to do that. We have to publicize to some extent what we own. Some things they wouldn't be able to buy because we make direct purchases. They wouldn't be able to buy into the businesses we own. But they might very well do better piggybacking us in some way, and they're certainly free to do it. Charlie?
Yeah, generally, I think it's quite smart to do what you're talking about, is to identify some investors you regard as very skilled and carefully examine everything they're buying and copy what you please. I think you have a very good idea.
Yeah, when I was 21 years old, I had to mail away to the SEC in those days. You got these crummy copies about a week later and paid a lot per page to get them. But I used to get the semi-annual reports of Graham Newman Corp before I went to work there, and I would look at every security that was listed there, and I got some of my ideas that way. So it's there's nothing wrong with that. Number 11.
Good morning, Mr. Buffett and Mr. Munger. I'm Mark Rabanov from Melbourne, Australia. I'm wondering if I could ask you, our retailing, manufacturing and service businesses have been severely impacted by the recession. Given the way consumer spending has changed, is it likely the results will still be 20% below 2007 levels in 3 years' time?
I don't know about 3 years' time. Certainly, those areas you named to varying degrees have been hit very hard. Some of the manufacturing would tie in with residential construction. If we hold housing starts at 500,000 a year, my guess is that in a couple of years at most, we would get something close to equilibrium in housing. Maybe quite a bit sooner. Nobody knows the figures with precision. But if you keep forming households at 1.3 million or something like that a year, and you create 500,000 new units, and a few of the old ones burn down and a few things, you will reach equilibrium at a point that's not ridiculously far in the future. And that will make a big difference in our carpet business and brick business and insulation business and paint business and so on. Retailing has been hit very hard. The higher the end of it, generally speaking, the harder it's been hit. There's been a big change in consumer behavior, and I think it will last quite a bit longer. I think for years government was telling people to save, and now that they're saving, they're unhappy about it. But I think the experience of the last couple of years, I don't think will go away very fast. I think it could last quite a long time. So I would not think our retailing businesses would do great for a considerable period of time. And I would say that in retail real estate, I would think that that would be a tough field to be in for quite a period. I think the shopping centers will be seeing vacancies that will be hard to fill. I think that their retailers will be struggling in many cases. And of course, the supply of real estate doesn't go away. So that could be the shopping center business, which was selling at these premier cap rates of 5% or even less sometimes. I think that is going to look very silly before all of this is done. In fact, it already is looking that way. So I wouldn't count. The service businesses are generally the better businesses. They require less capital, and they can be more specialized in what in the markets they serve in general. But I would not look for any quick rebound in the retail, manufacturing, and service businesses. We've got a ways to go on that, and we've got a ways to go on the ones that are construction related. But at least there you can sort of see the math of when it'll work out, and you can get a lot of information on what's going on in real estate markets. South Florida, I think, will be, for example, I think that's going to be a problem for a long, long time. I hope it isn't, but I just think the math of it is pretty devastating in terms of the number of units you have and net household formation down there. You've got a lot to wade through. Charlie?
I've got nothing to add.
Okay.
I got lots of questions sent in to me about the possibility of Berkshire buying its own shares. And here's what one said. You recently described Berkshire's policy regarding share repurchase as self-defeating because before a repurchase you said you would write a letter to shareholders explaining why we are going to do it. You said the letter would by necessity tell investors that the stock price was at a substantial discount to intrinsic value, which would cause the stock price to rise. The letter would be, in essence, a buy recommendation, though as a matter of policy, you don't make those. In the past, you have emphatically endorsed share repurchase by other companies and criticized managers who would not buy when the price was right. You have said no alternative action can benefit shareholders as surely as repurchases. Your previous views suggest little patience for a manager with a self-defeating policy. You've said when you have a manager who consistently turns his back on repurchases, when these are clearly in the interests of owners, he reveals more than he knows of his motivations. And the market correctly discounts assets lodged with him. Would it not be rational to conclude that the market will appropriately discount Berkshire's share price unless and until you abandon your self-defeating policy and engage in repurchases of shares?
Yeah, incidentally, and this is important actually, the comments I made about repurchasing overwhelmingly, those go back a lot of years when stocks generally were, or frequently were cheap in relation to intrinsic value. I did not make that. You haven't seen me writing about that in the last 10 years or so because I would say most of the repurchasing done in recent years I've thought has been foolish because people have been paying too much. And companies got, in many cases, they would never acknowledge this, but they were buying because they basically liked, they were trying to give out buy recommendations when buy recommendation when it wasn't justified. In the 70s and early 80s, Charlie and I would frequently urge people to repurchase shares because it was so much more attractive than other things they could do with their money. The only time we felt strongly that Berkshire should repurchase its shares was in roughly 2000, whenever it was that we thought it was demonstrably below intrinsic business value, and that we wrote we would do it, and it did become self-defeating. There's clearly a point where if we thought it was demonstrably below conservatively estimated intrinsic business value, and we notified the stockholders we were going to do it, we would do it. I think, again, would largely be self-defeating. I don't think that situation exists now. I think I won't give any buy or sell recommendations, but I think it ought to be quite compelling. Like I say, I think probably 90% of the repurchase activity I've seen in the last 5 years, I did not think was serving the cause of the shareholder. I thought it was being done because management thought it was the thing to do, and their investor relations department told them it was the thing to do, and they were actually buying stock at kind of silly prices. That was not the case when Charlie and I looked at Teledyne or the Washington Post or Cap Cities Broadcasting doing it many years ago, but I haven't seen situations like that in recent years. Charlie?
I've got nothing to add to that either.
It's interesting how many companies were buying in their stock at twice present prices that aren't buying it now. I mean, there are lots of those. We will never buy in our stock at a silly price. We may make a mistake by not buying it at a cheap price, but we'll never make a mistake, I don't think, by buying it at a silly price. And we think a significant percentage of corporate America has done that in recent years, including a few stocks that we've owned ourselves. Number 13.
Jack Benben from Haworth, New Jersey. First, I'd like to thank you. I've been to about a dozen meetings. This is probably the best one. So thank you very much for the new format, and thank you very much to the journalists who really helped out a lot.
Yeah, I agree.
At past meetings, you and Mr. Munger have talked at great length about opportunity cost. Excuse me. The past year has presented you with many unusual opportunities. Can you discuss some of the more important opportunity cost decisions of the past year, and were those decisions at all affected by the macroeconomic picture? Thank you.
Well, certainly opportunity cost has been much more in the forefront of mind in the last 18 months, when things are moving very fast, when both prices are moving and in certain cases intrinsic business value is moving at a pace that's far greater than we've seen for a long time. It means that in terms of calibrating A versus B versus C, it's tougher, it's more interesting, it's more challenging, but it can be way more profitable too. But it's a different task than when everything was moving at a more leisurely pace. And I described earlier, we face that problem, and it's a good problem to have. We face that problem in September and October because we want to always keep a lot of money around. We have all kinds of extra levels of safety that we follow at Berkshire, and we will never get so we're dependent on banks or other people's money or anything else. We're just not going to run the company that way. So we were seeing things happen. I mean, we got a call. We got lots of calls, but most of them we ignored. But the calls we got that we ignored helped us calibrate the calls that we paid attention to, too. And if we got a call from a Goldman Sachs, I think it was on a Wednesday maybe, that was a transaction that couldn't have been done the previous Wednesday and might not be done the next Wednesday. And we're talking real sums, $5 billion in that case. And we had certain commitments outstanding. We had a $3 billion commitment out on Dow Chemical. I think at that point, I could be wrong exactly on the day when we made it, we had a $5 billion commitment out on Constellation Energy. We had $6.5 billion we were going to have to come up with in early October on the Wrigley Mars deal. So we were faced with opportunity cost type considerations. And as I said earlier, we actually sold something that under normal circumstances we wouldn't have thought about selling if it was 10 or 15 points higher in Johnson & Johnson, but we just didn't want to get uncomfortable. So you are faced in a chaotic market, particularly where people need large sums. So you're not talking about buying $100 million worth of something, one day and $100 million the next day, but all of a sudden you're called on for billions if you're going to play at all. We face that opportunity cost calculation frequently during that period. I mean, when we decided to commit to buy Constellation Energy, we had to be willing to come up with $5 billion 7 or 8 months down the line. You didn't know exactly when because it would be subject to Public Utility Commission approval. But if something chaotic happened in the market next week, we would get phone calls or we would see stocks selling or bonds selling at prices we liked. And if the relative values against what we held were interesting, we might sell things. Now, it's harder to sell things in huge quantities than it is to buy things in huge quantities during a period like that. So you have to measure whether you can actually get the offsetting transaction done to move from one to another. We have if we're going to move billions from, we may have been moving hundreds of thousands or tens of thousands of dollars from one holding to another. We really can have big transactional costs unless we're careful. But that's the kind of calculation we go through, and we love the fact we get the opportunity to make those calculations. It's a sign of opportunity around, and we haven't had the flurry of activity like we had last year for a long time. So it was the first time we really faced the question, can we raise a couple $1 billion in a hurry to be sure that we've offset the cash needs of what we're committing to on the purchase side. On the Johnson & Johnson we sold, we actually made a deal where we had a floor price on what we would sell that for, just because the markets were so chaotic that we wanted to be absolutely sure that we would not end up a couple $1 billion less than comfortable when we got all through. Our definition of comfortable is really comfortable. I mean, we want to have billions and billions and billions around, and then we'll think about what we do with the surplus. Charlie?
Again, I've got nothing to add.
This question actually comes Just came across the BlackBerry before lunch from what I think is an audience member. Josh Wolf of New York writes the following. BYD appears to be more like a venture capital speculative investment than a value investment. Would you both explain that investment, your logic behind it, and your expectations for it?
Yeah. I'm going to turn that over to Charlie in just one second, but Charlie and I think there is no other kind of investment than a value investment. In other words, we don't know how anybody would invest in a non-value investment. And so we've always been puzzled by the term value and saying that contrasts with growth or anything. Value relates to getting a lot for the expectable flow of cash in the future in terms of what you're laying out today. So we've always, every time somebody characterizes us as value investors, we always ask them what other kind can there be. But Charlie is our team leader here on BYD, and he gets very excited. So I may have to control him, but go to it, Charlie.
Yes, well, of course, BYD, although its founder is only 43 years old, is not some early stage venture capital company. BYD is one of the main manufacturers of the world of the rechargeable lithium battery, and it achieved that position from a standing start at zero under the leadership of the founder, Wan Chuanfu. And they went on into cell phone components and developed a huge position. And then finally, not satisfied with having worked a couple of miracles, Wan Chuanfu decided he would go into the automobile business. As nearly as I can tell, there was zero experience in automobiles, and from a standing start at zero and with very little capital, he rapidly was able to create the best-selling single model in China. And that's against competition that was Chinese joint ventures with all the major auto companies of the world, technological marvels with way more capital and so on. This is not some unproven, highly speculative activity. What it is a damn miracle. And
I warned you.
And of course, Wan Chuanfu has hired 17,000 engineering graduates, and those engineering graduates are selected from 1,300,000,000 people in China, and he's hiring at the top of the classes, and so you get a remarkable aggregation of human talent. And then you've got the basic quality of the Chinese people, which, when unfettered from the wrong kind of government, for instance, the wrong kind of emperor, the Chinese people succeed mightily. When they came to this country as coolies, slaves, they would leave and soon be the most important people in the town. So this is a very talented group of people. And in a sense, this particular period may be Chinese, the Chinese day. And of course, these batteries, these lithium batteries, are totally needed in the future of the world. And we need them in every utility company in America. We need them in every utility company of the world. And we have to use the direct power of the sun, and we can't do that without marvelous batteries. And he's in the BYD is in the sweet spot on that stuff. And I know it looks like a miracle, and it looks like Warren and I have gone crazy, but I don't think we have.
Well, one of us at most.
And that car you're going to see in the annex I think they make everything in that car except the glass and the rubber. There may be a couple of small exceptions. That's unheard of. Whoever went into the automobile business and made every part and made it and made the automobile a best-selling thing. This is not normal. I mean, this is very unusual, and I regard it as a privilege to have Berkshire associated with a company that is trying to do so much that's so important for humanity when you get right down to it. Because it may be a small company, but its ambitions are large, and I don't want to bet against 17,000 Chinese engineers led by Wan Chuanfu, plus 100,000 more talented Chinese in a brand new area constructed the way they want it. I will be amazed if great things don't happen here. I don't think, given the size, it can be all that important to Berkshire financially. But I have never in my life felt more privileged to be associated with something than I feel about BYD.
BYD was Charlie's last year. The Irish banks were mine. So he's the winner. BYD, incidentally, does $4 billion a year of business. I mean, so it is not a small business, and it will probably get a lot larger. Let's go to the area 2.
And the question is, how would you quantify the financial impact and damage of Berkshire losing its AAA credit rating, which increased the cost of capital of Berkshire, which was surely a competitive advantage for the company? And Warren, what are you doing actively to try to restore Berkshire's AAA rating? Do you think that Berkshire will be able to regain it?
Well, it won't regain it soon because I don't think rating agencies will turn around like that, even if they should. We have a AAA from Standard & Poor's, but it's provisional, and they're going to look at it in about, I think they said about 12 months. Moody's affirmed the rating early in January. Then we issued a bond at one point where that was right after the rating changed. And actually, in terms of our credit default swaps, which is a metric you can use for credit acceptance, although I'll tell you in a second, it's an interesting aspect of that. That spread came down, actually. It makes very, very little difference in our borrowing costs. I mean, very little. And it never has, incidentally. I mean, AA's versus AAA's, the spread has always been very small, and people would argue in finance classes and all that it wasn't worth paying the price to have a AAA because you didn't save that much on debt, and it cost you in terms of return on equity. I never subscribed to that, and I very much liked having a AAA from both Moody's and Standard & Poor's. I was disappointed when Moody's downgraded us. We didn't really think that was going to happen, but it did. And it doesn't have any material effect on borrowing costs. It does cause us to lose some bragging rights around the world in terms of our insurance promise, although nobody ranks ahead of us, that's for sure. But it will not change back in a hurry. I mean, people don't make decisions in committees that they reverse very quickly. It's just not human nature. We're still a AAA in my mind, and actually we're a AAA in Standard & Poor's mind until we hear something differently. We certainly think, and we run it in a way that there can be no stronger credit than Berkshire. It's difficult for a rating agency, if they have a checkbox system of ratios and such, to measure something like the attitude of management toward creditors. But I will assure you that Berkshire has a management that regards meeting its obligations as sacred and a lot more important than increasing earnings per share or anything of the sort. I mean, we have obligations to people in something like workers' compensation that go 50 years out in the future. I mean, this is somebody that's been injured severely, and they get a check every month from Berkshire, and that's a lot more important than whether we earn X or X plus a tenth or a couple of tenths % on equity. And we conduct ourselves, or we certainly try to conduct ourselves, so that not only will people get those checks, but they'll never have to even worry about getting those checks. And that's very difficult for a rating agency to quantify that attitude on the part of the management of Berkshire. But believe me, it exists. And I would say that the AAA change at Moody's is not going to be material in the future of Berkshire, but it still irritates me. Charlie?
Well, at least they showed a considerable independence.
Yeah. Who knows? That may have entered into it, too.
Yeah. My attitude is quite philosophical. I think the next change at Moody's will be in the opposite direction. And I think that will happen because we deserve a higher rating and they're smart.
When Charlie and I disagree, and we do disagree a lot, we never argue, but we disagree. And Charlie, when he gets to the point where he really wants me to do something, like buy the BYD interest or something, he always says to me, well, he says, in the end, you'll see it my way because you're smart and I'm right. It's very hard to imagine that we won't find more things to do in China over time. I mean, it's a huge market. We do a lot of things, and some of those are exportable, and there will also perhaps be opportunities to buy more businesses there. We would have bought more than 10% of BYD if we could have, but that's all that they wish to sell us. So we hope that comes about. In terms of the Chinese dollar holdings, in a way they can't get rid of owning more dollar assets. I mean, the nature of it is, if we're going to run as we did a few years ago, or a year or two ago, if we're going to run a $250 billion trade deficit with China, I mean, if they're going to send us goods, and we want those goods, to the tune of $250 billion more than we sell to them, they end up with $250 billion of little pieces of paper. And they can convert those pieces of paper, called US dollars, they can convert them into US real estate, into US stocks, US government bonds. They can do all kinds of things. They can even trade them to the French, and get euros or something in exchange, but then the French have the problem. So the Chinese dollar assets are going to build as long as there's a significant trade surplus with China. And then they have the choice of what to put those dollars into. And they have elected so far to put a significant amount into U.S. government bonds. And I think a major official about a month ago or so in China said he wasn't too happy about the prospect of what's going to happen in terms of the purchasing power of that money that's been put in U.S. government bonds. And I would say he's right. I mean, anybody that owns dollar obligations outside of this country, if they hold them a long time, is going to get less back in the way of purchasing power than existed at the time that they took on those dollar obligations. And it's a major problem. Not the world's worst problem, but it's a major problem for a finance minister or a government in China to decide what to do with this buildup that comes about because they are running a trade surplus. And they've set up the Chinese Investment Corp, which has a couple $100 billion in it in terms of deciding to make investments around the world. But it's an interesting question. If you made me the finance minister of China, what I would do with the trade surplus, the funds that came in because of the trade surplus. And I think I'll turn it over to Charlie and ask him what he would do if he were the finance minister of China.
Well, I regard that as a very easy question. I would do exactly what they're doing. I think China has one of the most successful economic policies in the world. And China has advanced more rapidly than the rest of the world, and I would say their policies are exactly right. And their rate of advance is so great and so meaningful that if they lost a little bit of purchasing power on their dollar holdings, it's a trifle in the big scheme of things from the viewpoint of China. So I've got nothing but admiration for the way the Chinese have been running their own affairs. And they're going to be very hard to compete with all over the world, and that is exactly the correct policy for China. That's the way you get ahead fast, is to be very hard to compete with all over the world. So I think they're doing it exactly right, and I think that the United States and China should be very friendly nations because we're joined at the hip.
So you'd suggest they keep buying U.S. Treasuries at
probably
no yield?
Whatever they yield. They're not no yield because they can buy longer.
Okay, we've got some advice for the Chinese government. Carol?
Yes, sir. Mr. Buffett, Mr. Munger, I'm Chuck Hosmer from California. And you mentioned earlier the union cooperation at the Buffalo newspapers. Without the introduction of unions, how do you view contracts for other employees of BRK subsidiaries?
I'm just trying to think whether we have any real contracts.
I hope not.
Yeah, we are not big believers in contracts. We hand people hundreds of millions or billions of dollars in some cases to sell us their business. And the decision we have to make is, are they going to have the same passion for the business after they hand us the stock certificate and we hand them the money? Are they going to have the same passion that they had beforehand? And if we're wrong on that, no contract is going to save us. We don't want relationships that are based on contracts. So I can't really think of a formal contract that we have. We have understandings about bonus arrangements and that sort of thing, and that's not that complicated with various managers. I mean, we have the comp of the top person at each company is basically my responsibility, and we have all kinds of different arrangements because we have all kinds of different businesses. Some of our businesses, capital is an important factor, and so you have to put that in the comp arrangement. Some of it, capital doesn't mean a thing. Some of our businesses are very easy and very profitable. Some of them are very tough, and it takes a genius to get a so-so result. So we have a whole bunch of different arrangements on that, but we don't try to hold people by contracts, and it wouldn't work. And we basically don't like engaging in them. So you're looking at a company that. Can you think of any contracts we have, Charlie?
No. Our model is a seamless web of trust that's deserved on both sides. That's what we're aiming for. The Hollywood model, where everyone has a contract and no trust is deserved on either side, is not what we want at all.
Yeah, we do not want to negotiate the size of the executive bathroom. I mean, that is not our game. Becky?
Okay, this question comes from John McDonald, and he asks, Warren, in your General Electric and Goldman Sachs investments, do you think you've picked attractive businesses or simply attractive securities? Ben Graham's security analysis suggests that the most frightening things an executive management can do is manage earnings, which it could be argued both of these firms do. What is your reaction to that?
Well, I could say that I could argue that a very substantial percentage of American industry over the last 15 years at one time or another has managed earnings, and I've witnessed it and argued against it and gotten no place. So I don't regard that as a malady that's limited in its experience. I don't know anything. I would not get into the specifics of those companies. I felt good about those companies in terms of the quality of the businesses they had and the quality of the management. But it was the terms primarily that caused us to make those deals. I mean, those were made in a period when markets were in chaos, and and you should have gotten very good terms for committing money. That very few people were either willing or in most cases able to commit major sums on short notice. And it took good terms in order for us to do it. And like I said, I'm not sure there was any second possibility in those cases. It was a really extraordinary period. We were happy to do it. I feel good about the deals, obviously, because we got a very good coupon. But considering the circumstances under which the deals were made, I don't think there was an alternative. So if they wanted $5 billion and $3 billion respectively on those deals, I think we were the low bid in effect. But I also think we made very decent deals. And could we have done something better with the money at that time? I don't know. As I measured at that time, I could not find anything that I liked better. It was the terms of the deals overwhelmingly, although we obviously like the businesses. I know the managers, the CEOs of both companies very well, and I think they are terrific people. I think they're smart people, and I think they've been very straight with us long before we made a deal with them. So we're very happy with those deals. Charlie?
Yeah. There's been a lot of criticism of investment banking in this arena, starting with that movie. But Berkshire itself has had marvelous services from all of its investment bankers, which is interesting.
Think of what we'd be saying if we'd been mistreated. We've done a lot of business with Goldman Sachs over the years, and my experience goes back to when I was 10 years old and met Sidney Weinberg, who was running the firm and was a legendary Wall Street. Well, he was Mr. Wall Street for a long, long time, and I was a friend of Gus Levy's, and Gus Levy also did some really nice things for us, including when we had a little nothing company called Diversified Retailing, which Charlie and I and Sandy Gottesman jointly formed. Gus came in on an underwriting of a $6 million issue brought by New York Securities, which he wouldn't have dreamt of coming in, in that kind of a deal under most circumstances. And he had Goldman Sachs join in at that time. So there have been a lot of things that have made for a very happy relationship with Goldman Sachs. I feel good about them. And of course, we do lots of business with General Electric. We've bought I don't know how many of those wind turbines from them. But GE is a very, very important American institution. We'll sell them a lot of things, we'll buy a lot of things from them, and we'll make money on our investments. So that keeps me happy. Area 8.
Mark Hoffman from San Diego, California. Just want to thank you for all your wisdom and advice over the years. Also like to thank the boys at the Blumpkins, the Furniture Mart. They gave us a great tour the other day. I'm from an organization called the EEO, and they really showed us the culture at Berkshire and what you guys do. My question is, looking at the overall world economy, the Berkshire businesses are great, but my question is there underlying issues you see in the world economy, like going off the gold standard 40 years ago and fiat currency and countries making money like crazy? If the Berkshire businesses are great, but the underlying economy is a problem, where do we go from there? What are the questions you're asking yourself about the world economy? Thanks.
Yeah, there's always a lot of things wrong with the world. Unfortunately, it's the only world we've got. I mean, so we live with it and we deal with it. But the beauty of it is this system works very well. I don't have the faintest idea what's going to happen in business or markets in the next year or 2 years. But the one thing I know is that over time, people will live better and better in this country. We have a system that works. It unleashes human potential. I was just thinking, we have today about 35,000 people here. That was almost 1% of the population of the United States in the first census in 1790. Just 100 groups like this and you were talking the whole country. If you look at if we'd had this room filled back in 1790 with 35,000 citizens of the United States, then they would have been just as smart as we were natively, their intelligence. They would have lived in a country with resources that obviously same fertile soil, the same temperature, the same minerals, all of that. So they were just as able as we are, but they weren't turning out anything like we turn out today. I mean, just look at how we live compared to those people several hundred years ago. So we have had a system that works. It unleashes human potential. And China went for a long time without a system that unleashed potential. Now they've got a system that's unleashing human potential. We haven't reached the end of that road by a long shot. I mean, we're just starting, basically. We will have bad years in capitalism. I mean, it overshoots in markets. It gets overcome by fear and greed and all of that sort of thing. But if you look at the 19th century, you know, we had a civil war and we had 15 years or so of bad economic times spread out through that century. We had six panics, as they called them in those days. In the 20th century, we had a couple of great wars, and we had plenty of recessions, and we had the Great Depression. So we have these interruptions in the progress of our society. But overall, we move ahead, and we not only move ahead, we move ahead at a pretty damn rapid rate when you think about it. I mean, when in the 20th century, we had a 7-for-1 improvement in living, and we did that. You know, we had slavery for a long time. We had blacks counted as 3/5 of a person. We didn't let women vote for 130 years or thereabouts. I mean, we were wasting human potential, and we still are, but we were doing it more so for centuries. But we do keep moving forward in kind of fits and starts. And right now we're sputtering somewhat in terms of the economy. But there's no question in my mind that there is enormous human potential, and that at every period, every year we will meet, you can name a bunch of problems. I mean, it will happen, but the opportunities will win in the end. And you know, your kids will live better than you live, and your grandchildren will live better. And we will find more and more ways to find easier and better ways to do things that we haven't even dreamt of yet. Charlie?
Well, now that I'm so close to the age of death, I find myself getting more cheerful about the economic future, which I'm not going to be here to enjoy. And what I find really cheerful is that we are plainly going to harness the direct energy of the sun, and we're going to have electrical power all over the world, and that's going to enable overpopulated countries to turn seawater into fresh, and it's going to eliminate a lot of the environmental problems and preserve more of the hydrocarbon resources for future needs as chemical feedstocks. What I see is a final breakthrough that solves the main technical problem of man. And you can see it coming right over the horizon, and of course Mid-American and BYD will be participating in it. So I think it's usually a mistake to think only about your probable misfortunes. You should also think about what's good about your situation. And what's good about our situation now is the main technical problem of mankind is about to be fixed. When you have enough energy, you can solve a lot of your other problems.
He is getting more optimistic as he gets older. Carol?
Good afternoon, Mr. Buffett, Mr. Munger. Jimmy Chong here from Dayton, Ohio. Mr. Buffett, in October of last year, you wrote in a New York Times op-ed piece that you were moving your personal portfolio to 100% U.S. equities. My question is that move complete? If not, are you still buying? And in addition to that, how would you rank the recent market downturn in terms of investing opportunities in stocks during your investment careers?
Well, it's certainly not as dramatic as the 1974 period was. Stocks got much cheaper in 1974 than they are now, but you were also facing a different interest rate scenario, so you could say they really weren't that much cheaper. You could buy very good companies at 4 times earnings or thereabouts with good prospects, but interest rates were far higher then. That was the best period I've ever seen for buying common equities. The country may not have been in as much trouble then as we were back in September. I don't think it was, but stocks were somewhat cheaper then. In the recent period, I bought some equities, and then corporate bonds looked extraordinarily cheap. The spreads were very, very wide, so I bought some of those too. But the cheaper things get, the better I like buying them. I mean, if I was buying hamburgers at McDonald's, the other day for X, and they reduced the price to 90% of X tomorrow, not likely, but if they did, I'm happy. I don't think about what I paid yesterday for the hamburger. I think I'm going to be buying hamburgers the rest of my life, and the cheaper they get, the better I like it. I'm going to be buying investments the rest of my life, and I would much rather pay half of X than X. And the fact that I paid X yesterday doesn't bother me if I get it, as long as I know the value is in the business. So on a personal basis, I like lower prices. I realize that is not the way all of you feel, and that when you wake up in the morning and look at quotes, but it just makes sense that when things are on sale, that you should be more excited about buying them than otherwise. And lately, when I wrote that article at the Times, I did not predict what stocks were going to do, because I never know what they're going to do. But I do know when you're starting to get a lot for your money, and that's when I believe in buying. Charlie?
Well, if stocks go off 40% on average, they're obviously closer to an attractive price than they were before. And of course, interest rates have gone down a lot recently, at least short-term interest rates. It's nothing like 73.4. No. I knew when that happened that was my time and my only time. I knew I was never going to get another trip to the pie counter like that one. Unfortunately, I had practically no money available, which is...
That's why it happens.
That's why those times occur.
Yeah.
So, if I were you, I wouldn't wait for 1973-4.
No, we don't try to pick bottoms, we don't have an opinion about whether the stock market's going to go tomorrow or next week or next month. So, to sit around and not do something that's sensible because you think there will be something even more attractive, that's just not our approach to it. Anytime we get a chance to do something that makes sense, we do it. And if it makes even more sense the next day, and if we've got money, we may do more. And if we don't, what can we do about it? So picking bottoms is basically not our game. Pricing is our game, and that's not so difficult. Picking bottoms, I think, is probably impossible. But when you start getting a lot for your money, you buy it. And as I say, after I wrote that, stocks did get cheaper. Corporate bonds, the corporate bond market got very, very, very disorganized, and we bought some fairly good sized pieces of bonds for Berkshire, and I also bought a few little things for myself. But I spend 99% of my time thinking about Berkshire. That's
Warren, by now, don't we have our small life insurance companies pretty well full of desirable debt instruments at 10%?
We certainly have got a lot more of it than we had. Yeah, no, we got a chance to buy some corporate bonds very, very cheaply, at least in my view, a few months back, and we had money in life companies that can't be used in certain other areas, and for which this was an ideal time to just barrel in. And anytime we like to do something, we really like to do it. I mean, our idea is not to tiptoe into anything, so we buy them as fast as we can when prices are right.
Yeah, that bond thing didn't last very long.
No.
But there were perfectly safe bonds that yielded 9% or more with very fancy call protection.
Yep.
And some of those bonds are up 20-25%.
Yep.
So the opportunities are frequently under shell A when you're looking at shell B.
Yeah, we try to look at all the shells.
Yeah, we look at all the shells. Right?
Yeah. Becky?